All right, guys. Okay. I knew I'd have to do a podcast commentary for this one. This is the potentially 60-year, but definitely 30-year. And then there's some 10-year cycles that I was able to spot out for the entire financial world. So essentially, as we've been showing, it's ratio charts. And if you're able to identify the correct asset classes, so let's say US equities, metals, energy, inflation, and you do ratio charts with them, you're able to spot the macro tidal wave paradigm shifts that occur. And that, drives price because I could overlay a lot of charts that will look like a ratio chart of those major asset classes. All right. So that it comes back to when people say gold or the miners or silver aren't tracking gold. Silver and the miners are not tracking gold. They are tracking gold's relative performance to SPX. And if I would have overlaid the gold to SPX ratio with the silver chart or the miner charts, it looks practically the same, or uranium miners, all that. So gold is one of those major asset classes that you could compare to SPX, or you could use the PPI, and I'm going to pop up the screen here. You could use the PPI here versus SPX. And the huge advantage of this is we have data going all the way back to 1913, all the way back here, guys. So this is huge, huge, huge. I'm going to zoom out. So let's start with this. Because I have over 100 years of data, I'm able to spot the longer term cycles, because especially those 30-year cycles, when you just look at the gold price that starts in 1970, then 30 years, like you need a couple of samples of completed 30-year cycles to say, okay, this is a good thing. Just like a trend line needs 3 touches, and then on the break on the 4th, that was a valid trend line break. Well, cycles, same thing. If I get 3 previous cycles, then my confidence level that I'm in that cycle is increasing. So right here, I have SPX divided by PPI, and I overlaid the silver chart. But right now, let's just focus on this chart here. So here are my big domes. My big domes are 30.68 years. And look, I'm not a stickler for the dots and all that. It's approximate, right? There's no reason to say, oh, Patrick, it's not exactly the same. So what I tried to sync it with was the bottom, not the ultimate bottom, but the bottom before the move up, before SPX started rising against versus PPI. Because you got to remember, when SPX is right here at its top of its cycle versus PPI, that means US equities are severely outperforming silver, US oil, whatever. And here I put silver, guys, just a reminder again, because gold was pegged prior to 1970. So you get more granularity, more movement. I could have put the US oil chart, it's practically the same. But with silver, you get to see the market forces since it wasn't pegged. And you see here when SPX was peaking versus PPI, silver was bottoming right here. Broke down, sleep mode line. Then after that, so this people, cycle guys, they call this left translated because it was a peak on the left hand side of the bigger hemisphere. Then silver bottoms here, and that was the bottom for silver. And after that, there's 2 smaller cycles here. Those are 15-year cycles. And as those play out, this was a right translated 15-year cycle. This was a practically center or slightly left translated cycle where silver bottoms in each of the occasions, where SPX versus PPI tops in each of those occasions. And after that, it goes all the way down. And what happens at the end of the 30-year, here's a silver top. Here's another silver top right here, silver tops. SPX bottoms versus PPI, and that's it. Then it starts a new 30-year cycle. So this 30-year cycle, same thing happens again. Keeps going up, up, up. It peaks pretty much in the center, slightly right translated of that 30-year cycle. And for each of these 15-year cycles, silver peaked or bottom. So sorry, silver bottom was pretty flat here. It was silver bottom when PPI peaked, and that right translated. And here was pretty much a center, slightly left translated. SPX peaked versus PPI, and silver bottomed right there. So you have 15-year cycles within that 30-year cycle. And this, as this unwound, and silver peaked. So here you have a silver peak at every time SPX to PPI tops, peak, bottoms, peak for silver as the SPX to PPI bottoms out and then starts turning back up. Then you start a new 30-year cycle in favor of SPX outperforming PPI. Those two 15-year cycles, right translated, silver bottoms when SPX versus PPI peaks or moves sideways, but it was so powerful. It never went below the sleep mode line here. I'll come back to this sleep mode line just a little later. Let's just focus on the cycles. After that, SPX had another strong up leg. And then after that, it peaked right here, pretty much at the center of that 15-year cycle. And slightly a little bit before that 30-year cycle, it peaked right above here. So now those two peaks together, the 15 and the 30. And then after that, down she goes. Silver moves up, 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 up. And silver peaks exactly at the end of that 30-year cycle where SPX refuses to go down versus PPI and goes up. So where we are today. So if this, we have had 3 cycles happening, confirmed. 1, 2, 3, 4, 5, 6 15-year cycles confirmed. Right now, we're actually, SPX versus PPI is probably topping out in its 15-year cycle, just like it did here in 1962, just like it did maybe in 1930. We're approaching a point where, especially here, this is the trend line. It's already had a trend line break based on the closes on the monthly chart. I know of the wicks. There's probably some room for the SPX versus PPI to bounce up. Here's a provision early breakout line. I just copy pasted the one from the 1930s, same angle right here. So we're probably right here. This will, each time you see previously when SPX was topping versus PPI, silver after that, depending if it was in below its moving averages or a long-term bear market, that was a low here. So the first low here, silver always did a higher low at the bottoms. Low, higher low in between those 15-year cycles. Low, higher low. So right now, we got to assume that whatever we hit here, when this breaks down, we're approaching a low that silver will not see again. All these lows, this low here is never seen again. This low here is never seen again. This low here, the first low is never seen again. So that's where we are right here. I also measured in between those two silver lows, there's about 10.18 years, between those two lows. Same thing here. And so we're trying to use that evidence to say, okay, silver might have moved up, might go sideways. Remember, this is a log chart. So look at this here. I didn't put a line here. I'll show you the other pictures later, but this is a log chart. So even people think that, even if it goes sideways and goes up just a little bit like that, from this point here in dollar values, just if silver climbs up here a little bit, that's $50 silver from where it is now, 18. And then after that, could come back down, create a higher low, testing $30 before doing an end game parabolic melt up. Much later in the decade, triple, quadruple tickets could happen. Like triple digit silver, quadruple digit silver could probably happen, but after 2032. Right now, this play here is silver going up above all-time highs. How high, I don't know. But this is the play right here. And this is the takeaway, guys. I know a lot of people, I'm not going to see my triple digit silver. That is your greed kicking in. There's going to be a great play right here when silver breaks above 28, or even the wake up line when it breaks above 22, and you'll be able to ride that 22 to whatever, 45, 55, 60, wherever there's a crazy small melt up. But that will not be the end game melt up. Whatever happens here is not going to be the end game melt up. All right. I'll come back to those sleep mode lines and give a little bit more detail. First, what I'm going to do is go back to a few other charts that our members at the North Star Bat Charts got. And remember, we have a 60% off yearly subscriptions right now, ending in a couple of days. And even if on Twitter I put this simple chart, this is all the commentary the guys got on the website ahead of time, and 3 more charts, which I'm going to show you right now. In this version, I overlaid the US Purchasing Power Index. It's great because this data is available from the Fed, and you see how it tracks. And I'll show you some more tools to extrapolate data from where it starts going flatlining, because you could barely see it once it's approaching the zero bound. But when the purchasing power was sky high, look how well it tracks the SPX to PPI ratio. This is what I'm telling you about, these big asset classes. When you measure them, once you've identified them correctly and you measure them one versus the other in a ratio chart, you see these huge, everything tracks, it's financialized. So essentially, the purchasing power is tracking, or you could say the SPX to PPI ratio is tracking your purchasing power. And look at that. And purchasing power essentially is the US dollar strength versus other currencies adjusted for inflation. I could have put the DXY divided by PPI, and it would have probably looked like this if I would have had data prior to 1960 or wherever, 68, wherever the DXY stops. So you see it tracks it. Goes down, goes down. Every time there's a cycle where the US purchasing power breaks down, then we're starting a new cycle in favor of PPI outperforming SPX. So that's the added information, the added weight of evidence to remove more analysis paralysis. You got to add evidence to not be afraid to understand where you are. And you'll see why this section here might outperform more than it did in the mid-90s for this exact reason. All right, so I'll go to the next chart, guys, what I did. What I did here is I put the 5-year rate of change for the US purchasing power. So the 5-year rate of change, multiples, it's half of the 10, it's 6 of the 30, to try to make it fit logically with the cycles that we have. So if I would have put smaller cycles within those 15-year cycles, 5-year cycle would have been divisible, would have been a third of each of these ones. So I put this down here. I wrote 4 here, but it was 5 because I had played around with the 4-year rate of change, but after that I changed it. Right here, you see .60? Right here, that's what it is. So I put that information down here. So I'm going to zoom in to show you how this plays out. Here is the potential 60-year cycle. There's just one here. So I don't know if this is going to be a 60-year cycle, 61-year cycle, but I do know there's 2 30s in here. 1, 2, and then we complete a third one. But look at the rate of change of purchasing power. And this gives you clues to where we are here. So here is the first breakdown. So the first top of the cycle for SPX versus PPI, or for purchasing power, increases, the timber, down it goes. And that's when silver went up, US oil went up, and SPX went down versus inflation. It goes down, bottoms here, goes up, creating another top here. I drew this line here, but I could have drawn it here. I could have drawn the line across here. Beautiful left rising head and shoulders, breaks down. So that is the second minor top that broke down. 2 minor tops, lower high, creating a neckline where it breaks down. And that's the major endgame top. And look, that's 1969, guys. So when the purchasing power broke down from this massive, massive top, this 40, 50-year top, depending from these 2 cycles, this is creating this mega structure, 60-year potential cycle, or at least a 60-year top breaking down. And this is where silver went crazy. It did good before on the log scale, but this is when you get crazy, crazy digits. So this thing's bottom, 1980, purchasing power, rate of change goes up. It's still below the zero line, guys. Don't make no mistake. Your purchasing power has not increased. It just has reflated, but below a negative line, right? So the rate of change, you're losing less and less, but you're still losing, right? So that's a big nuance. So, but when this has happened, was enough for US equities to outperform SPX, PPI. So here, creating another rising trend line break, that's 2000, guys. What happened in 2000 when that... So when the purchasing power rate of change stalled, that was enough to drive gold from 250 all the way to 1900. It was enough to drive silver from, $5, $6 all the way to 45, $50. Just this move here created that huge move in gold and silver. So that's the first minor top from that first half of that 60-year cycle, that 30-year cycle. So here's the top. Now I'm creating another top, minor top that broke down actually here. I have another line here, which also could be maybe my minor top. I'm not quite sure, but the takeaway is these trend lines are breaking. These less and less steep trend lines clearly break. One touch. 1, 2, 3, 4. Break down, retest, and breaking down. So maybe the major top, if it's not this line, guys, here, it's at least this line here. There's another one here. 1, 2, 3, and break down below that. Look, if this is not the major top breaking down, so this could be a left translated major top breakdown. Here was a right translated major top breakdown. The target, it's all the way down here, guys. So this line here, maybe it's going to go all the way down here. I don't know where this line's going to go down, but this is looking very ominous. So I have to take a deep breath, guys, because the rate of change for the purchasing power is telling you that something powerful is happening. So this is giving me clues that and maybe here, the end game, this mega line, 100-year line, maybe when we reach here, we're going to break down through there, and that's going to catapult the insane triple digit, quadruple digit silver, man. Maybe it's going to happen when we break down that line. But what this is telling me, guys, is, I'm going to zoom back out. This is telling me that this move here for silver might look like, and I'm going to go to comments, and here's another advantage. Our members, they get these extra charts, they get comments, they get to, we get to discuss, add feeling, not feeling, but just responses, nuances to all these charts. I had this chart here. So look at this one, guys. I just zoomed in on the silver chart in that section. I added the true breakout line because this is noise above important. It didn't last a long time here. So all this noise above the $28 line. Here you see we tested it. So that's a clear. For me, that's a breakout line. But look at this. I didn't touch the circles, but I saw that if 1, 2, 3, 4. I like when I see I have a rising trend line. And so let's say the rate of change for the purchasing power keeps going down. It's going to fuel gold and silver. I don't know how high it's going to go. I put it up here, but if it goes all the way up here, that's $50, $60, 80. Remember this log scale. I don't know how high this thing's going to go. Or even if it goes back all the way up here, it's just 40. And then if it goes back sideways, that's still a strong move to play. Then after that, we come to retest that rising trend line for the final endgame right translated 30-year cycle. And that shoots up to triple, quadruple tickets. But the takeaway is we're closer to a generational low than a generational top. And that's what it is when you're on the left-hand side of this 30-year cycle and you're on the right-hand side of that peak. That means U.S. equities have already putting in a peak. There's not much room for U.S. equities to really destroy, outpace PPI, right? It would have done it. It does it on the way. It does it here at the beginning here. But as soon as you start turning away from this, it's pretty much done. Except in the 2000s. Okay, so let's go back to the 2000s. Let's go look at those trend line, guys. Did I put a picture? Let me go back down. Okay, I think I did it here. All right, right here. It all depends what U.S. equities do. So let's look at 1939. See that sleep mode line right here, guys? That was it for the 30-year cycle when the bubble busted in 1929, 1930. That was it. U.S. equities they needed all that time just to come to bottom versus PPI, and they needed even more time. So they started raising, but they were already a third of the way in that 30-year cycle, topping halfway of that 15-year cycle and 30-year cycle just to break even. And after that, then it flew up, and then after that, it got to peak a little later and a slightly right translated cycle right there. So this is the case where as soon as you break down from that symbol line, it's over. 1960s, it broke down from a rising trend line, but after that, it was still got momentum, bounced on a longer term sleep mode line, and after that, it decided to topple over. In the 2000s, US equities got even more bullish because while they had peaked right here, slowing down versus PPI and silver bottom, even silver didn't do a new lower low in that second 15-year cycle for the right translation of that 30-year cycle, US equities did go in the dot-com bubble right here. So they did do very well bouncing on that line, and they outpaced inflation all the way up. But even if they outpaced inflation enough, it wasn't enough to bring silver down lower than the previous lows. So that was the ultimate bull case for US equities. This one was the ultimate bear case for US equities. This was somewhere in between. So the question is right now, are we having a 1929, 1930 type of crash where that's it for US equities and there's no bounce on this line? And it's possible right now because this line is pretty much the same angle of ascent as this one and the longer term ones, and it broke down. We'll know if ever there's another trend line here that morphs into existence and there's a bounce for US equities and the US equities go back above the early breakout line, somewhere like here, decide to go back above, then we'll have to revise and we'll say, okay, US equities, they still have some juice, but I don't expect silver to do new lows just because US equities are outperforming PPI. They're probably going to price in the eventual ending of that melt up, and they'll stick around here until US equities finally roll over, and then after that, then they have a strong leg up. So that's how I weigh the evidence. You can't just take one situation and say, oh, it's going to bounce here, or one situation you say it's going to break down, or it could be a combination of both these scenarios. You have to take all that evidence into account. And then after that, you could remove fear from your analysis. All right, guys, that's it. Leave some comments. Let me know what you think. But we're definitely closer to a generational low than a generational top. And that's the takeaway you should get from this, guys. Thanks for watching. Ciao, guys.